Because silver just did something that looks impossible if you still think of it as a calm, slow, safe haven metal. We hit a historic high at $93.61, and then, in roughly 3 hours, we snapped down to about $86.24. That's a 7-8% drop in a single afternoon. In the same asset people call the insurance, the hard money, the sleep well at night metal. So the only question that matters right now is simple. What just happened? And the second question is the one that protects your future. What happens next? Quick disclaimer, this is educational, not financial advice. Markets are risky. Manage your position size, your emotions, and your time horizon. All right, let's break this down like an autopsy. Clean, mechanical, no coping. The move wasn't normal selling. When you see a price fall 7 and 8% in 3 hours, your brain wants a story. Bad news. Someone found fraud. A recession. A whale sold. But most of the time, that's not how this works. Fast drops are usually not about information. They're about structure. They're about leverage, margin rules, liquidity gaps, stop cascades, and the dirty little truth of modern markets. Most price discovery happens in paper contracts, not in metal, so the flash crash isn't silver losing value in 3 hours. It's a highly leveraged plumbing system, yanking price around while real buyers and real sellers are still trying to breathe. Picture it like this. You're not watching a mountain collapse. You're watching a trampoline snap because too many people were jumping on it with borrowed money. At $93, silver wasn't just rising, it was accelerating. And acceleration is the danger zone because when price goes vertical, 3 things happen at once. Late buyers chase, shorts panic cover, exchanges and brokers get nervous. That third one is the killer. When volatility explodes, risk managers don't ask, is silver a safe haven? They ask, will my clients blow up and leave me holding the bag? And when they get nervous, they tighten the screws. They raise margin requirements, they widen spreads, they reduce leverage, they throttle liquidity. That turns a rally into a trap door. So the first and simplest explanation is this. Silver didn't change its mind. The rules of participation changed at the peak. The 3 engines of a flash crash. Let's name the engines because if you can name them, you can see them coming. Engine 1, margin and deleveraging. In futures, you control a lot of notional exposure with a relatively small amount of cash. That's the point. That's the leverage. But when price whips around, your broker may demand more cash today. If you don't have it, you don't get a lecture. You get liquidated. Not tomorrow, not politely, right now. So when silver rips to $93 and volatility spikes, thousands of accounts, big and small, suddenly receive the same message. Add collateral or reduce. And most people reduce. That creates forced selling. Engine 2, stop loss cascades. When price breaks down through obvious levels, stops trigger. Stops are market orders. Market orders don't negotiate. They hit the bid like a hammer. Then the next layer triggers, then the next. It's not one seller. It's a chain reaction of automatic selling, all firing into thinning liquidity. Engine 3, liquidity air pockets. In a calm market, there are bids stacked below. In a panic, the bids step back. Market makers widen spreads. Participants cancel orders. Everyone waits for stability. So when the selling wave hits, there's less cushion. Price falls faster than your brain thinks is possible. That's why it's called a flash crash, not because the world changed, because the order book disappeared. Safe haven doesn't mean smooth. This is where people get emotionally wrecked. They confuse long-term properties with short-term behavior. Gold and silver can be monetary hedges. They can protect purchasing power over years. But in the short run, they trade like risk assets when leverage is involved. Safe haven in theory, flash crash in practice. Because the market you trade is not a vault. It's a battlefield. And the battlefield is full of leverage. So if you want to understand a 3-hour dump, you stop asking, is silver safe? And you start asking, where is the leverage? Who is forced? Where are the stops? What are the margin rules? That's the adult version of this conversation. Why this particular drop felt so violent? Let's be honest, this wasn't a gentle pullback. This was a slap. Why did it feel like the floor vanished? Because the move up likely created a crowded one-sided trade. When price goes vertical, traders pile in with the same idea. I'll ride it and I'll get out if it turns. But getting out is not a plan when everyone has the same exit door. When the turn happens, the exit becomes a stampede. You saw it in the speed, 93.61 to 90, then 89, then the 88s, then 87, then $86. That's not healthy distribution, that's evacuation. Also, psychologically, 90 pluses is a billboard number. It attracts media, it attracts tourists, it attracts leverage. And tourists don't have conviction, they have stop losses. So the higher we pushed, the more fragile the structure became. The crash is the structure breaking. Was this manipulation? Let's handle the word everyone wants to scream. Manipulation. Here's the clean answer. Sometimes there are aggressive strategic sell programs. Sometimes there are games around liquidity windows. Sometimes big players push price to hunt stops. That's real. But you don't need a conspiracy to explain a 7 or 8% drop in a levered market. You only need high volatility, tight liquidity, crowded positioning, and forced selling mechanics. If you want to call that manipulation, okay. But the more useful view is this. The system is designed so that leverage gets punished fast, and the punishment is mechanical. It's not personal. It's just brutal. What the tape is telling you right now, I want you to think in phases. Phase A, euphoria. That was the $93 print. Everything feels obvious. Everyone feels smart. The move feels inevitable. Phase B, snapback. That was the $93 to $86 plunge. This is the market clearing out leverage. Phase C, decision. This is the next part. After the flush, price either stabilizes and rebuilds or continues lower as the unwind spreads. So the question is not, will it bounce? It's, is the selling still forced? You watch that by observing, does volatility compress? Do candles shrink? Do rebounds hold? Or do they get sold instantly? Do we reclaim key levels and keep them? If bounces get sold hard, the unwind is still active. If price can hold a base, the flush did its job. The levels that matter, without pretending to be a wizard. I'm not going to pretend I can predict the exact next tick, but markets are repetitive. Humans are repetitive, so you map zones. Here are the zones implied by the move you just witnessed. Zone 1, the panic low area, HIST 86. This is where forced sellers hit the wall. If price revisits this area and holds, it suggests selling pressure is exhausted. If it slices through, you know the unwind isn't done. Zone 2, the midpoint gravity, HIST 89.90. The middle of the crash range becomes the battlefield. Price tends to test it. Traders watch it. Algorithms fight there. A reclaim and hold above this area often changes sentiment from evacuation to rebuilding. Zone 3, the shattered peak, 93.61. This is now a scar. If price returns there quickly, that's strength. If it can't, the market may need more time to digest. And remember, in a blow-off environment, time can mean days, not months. Paper versus physical. The split you must understand. Here's the twist that confuses people. Paper silver can crash. Physical silver doesn't teleport. Mints don't suddenly pump out more supply because the futures chart had a tantrum. Industrial demand doesn't vanish in 3 hours. So what happens during a flash crash? Often, paper price drops fast. Physical premiums can stay sticky. Availability can remain tight. The real-world market moves slower. This is why the paper versus physical debate never dies, because moments like this expose the difference between a price printed on a screen and an asset that has to be mined, refined, shipped, and used. So if you're a long-term holder, you care about the thesis. If you're a trader, you care about the structure. Mixing the two is how people get wrecked. Who got hurt today? Let's call out the casualties. Over-leveraged longs. People who were right on direction and dead on risk control. They got margin called or stopped out at the worst time. Late chasers. People who bought the peak because the chart looked like a rocket. They didn't buy a medal. They bought adrenaline. It can't go down. Thinkers. Every vertical move creates a cult, and every cult gets humbled by gravity. The market's job is to punish certainty. What you do next? Battle plan. Now we get practical, because knowledge without a plan is just anxiety with fancy words. Here's a clean checklist. Step 1, define your role. Are you a trader? Are you a long-term investor? Are you a physical stacker? If you don't define this, the market defines it for you, and it usually defines it at the worst moment. Step 2, cut leverage to the bone. If you're using leverage, understand this. Flash crashes are leverage exterminators, so reduce position size until you can survive a 10% intraday move without panic, because today proved that's possible. Step 3, respect the volatility regime. After a move like this, volatility stays elevated. That means wider stops, smaller size, less ego. If you trade the same way you traded last week, you'll donate money. Step 4, watch for base building, not hero rebounds. You want to see price stop bleeding. You want to see higher lows, failed breakdowns, and calmer tape. The first bounce is often a trap. The base is the signal. Step 5. If you're long-term, think like a patient predator. If your thesis is monetary and industrial demand, you don't need to chase candles. You need to accumulate intelligently. That means stagger entries, avoid emotional buys, and keep cash for volatility. Let the market do the drama. You do the discipline. The story behind the story, zoom out for a second. A market doesn't go from $93 to $86 in 3 hours unless the positioning was extreme. That's the hidden message. The message is the trade is crowded, and when a trade is crowded, the shakeouts get violent. This is the price of a narrative becoming mainstream. Everyone wants the upside until the market charges them for it. What I'm watching in the next 24 hours, here are the 4 signs that matter more than opinions. Does liquidity return? Tighter spreads? Calmer tape? Less gapping? Does price hold above the panic low? Holding suggests the flush cleared weak hands. Do rebounds get sold immediately? If yes, forced selling may still be active. Does volume spike on the low, then fade? Classic capitulation signature. You don't need a crystal ball, you need a scoreboard. The market didn't break Sasamersis, it exposed. Today wasn't silver failing. It was silver exposing the difference between a long-term hedge and a short-term leverage machine. If you treat it like a savings account, you'll panic. If you treat it like a battlefield, you'll prepare. So here's your takeaway. The flash crash was a stress test for the market, for the plumbing, and for you. If you made it through without blowing up, you just leveled up. If you got hit, don't turn it into shame. Turn it into a system. And if you want me to keep covering these moves in real time, levels, mechanics, and the battle plan, hit subscribe and comment one word below, reset. Because after a move like 93.61 to 86.24, the next chapter doesn't belong to the loudest. It belongs to the most prepared. Minute by minute, how a rally turns into a trap. Let me narrate the movie you just lived through, because once you see the pattern, you'll recognize it the next time the screen starts shaking. Scene 1. The breakout celebration price pushes through a big psychological number. The chat rooms light up, headlines get drafted, people start speaking in certainties. New era, no sellers, straight to $100. Scene 2. The first hairline crack. You get a sharp red candle that doesn't get bought instantly. It's small, but it's different. Up until then, every dip was free money. Now the dip hesitates. Scene 3. The liquidity pullback market makers, the people who normally provide a cushion, widen spreads. Not because they hate you, because their models see risk exploding. When spreads widen, you're already skating on thinner ice. Scene 4. The level break price drops through a level that everyone is watching. The first layer of stops triggers. That selling pushes price into the next layer. Now you're not in a sell-off, you're in a stop cascade. Scene 5. Forced liquidations margin calls and risk limits kick in. And here's the part people don't understand. A forced liquidation doesn't care about your thesis. It doesn't care about value. It cares about collateral. If collateral isn't there, positions get closed. Scene 6. The panic low print. Eventually, price reaches the zone where sellers are exhausted and buyers finally step in. Not heroic buyers, patient buyers. The ones who waited for blood to hit the floor. That's the anatomy. That's the loop. And today, you watched it at high speed. The options angle. Gamma can turn into a meat grinder. Now let's talk about the invisible hand you don't see on most charts. Options. When a market runs hard, a lot of call options get bought. Dealers who sold those calls often hedge by buying the underlying. That dealer hedging can add fuel to the rally as price rises. But here's the flip side. When price starts falling back through key strikes, dealer hedging can flip. Instead of buying to hedge, they start selling as deltas change. That creates a feedback loop in the opposite direction. This is why some moves feel like up is accelerating. Then suddenly, down is accelerating. Gamma cuts both ways. And in a thin, volatile market, it can feel like a trap with teeth. Why did it drop if it's in demand? This is the most common confused question, so let's answer it cleanly. Demand can be strong, and price can still drop. Because short-term price is a function of liquidity, positioning, leverage, and forced behavior. Think about oil. Think about stocks. Think about crypto. A market can be fundamentally tight and still get slammed if leverage players are forced to unwind. So when someone says, silver can't drop, industry needs it, that's a long-term statement. Today's flash crash is a short-term event, different time scales, different rules. What could have sparked the first domino? We don't need one magic headline to explain this, but it helps to list the usual suspects that can light the match. A quick spike in the dollar, a sudden jump in real yields, a risk-off wave in broader markets, a broker tightening leverage, a wave of profit-taking into a thin window, a rumor of higher margins, a large fund hitting bids to reduce exposure fast, and sometimes it's as boring as this. The market ran too far, too fast, and the first large seller found no depth. Once the first domino falls, the cascade does the rest. The time window matters. Afternoon thinness is real. If this happened in a thin period, the move can look even more violent. Why? Because fewer participants are active. Order books can be lighter. Liquidity providers are more cautious, so when a big wave of selling hits, it has less resistance. That's why you sometimes see normal volatility in a deep window and insane volatility in a thin window. Same market, different depth. This is why just use a stop is not a complete plan. Stops are tools, they are not life jackets. In a flash crash, stops can trigger in clusters, and the fill you get can be ugly. If price gaps, your stop becomes a market order into an air pocket. So risk management is not only where is my stop, it's what size am I trading, what is the volatility, what is my leverage, and can I survive a gap? The market punishes sloppy answers. The psychology trap. Your brain is built to lose here. Let me tell you what your nervous system did today. At $93, you felt FOMO. You felt urgency. You felt like you were late. Then, minutes later, at 86, you felt fear, you felt regret, you felt like you were stupid. That emotional swing is not an accident. It's a feature of volatility. The market pulls your emotions like strings because emotions make you trade badly. So if you want to win long term, you do something that feels unnatural. You slow down when the market speeds up. You breathe. You reduce size. You wait for structure, because the fastest decisions are usually the most expensive. 3 lies people tell themselves in a flash crash lie. 1. It's going back up immediately. Sometimes it does. Often it doesn't. Hope is not a strategy. Lie 2. I'll just average down until I'm right. Averaging down with no plan is how you turn a bruise into a fracture. Lie 3. I'll sell now and buy back lower perfectly. Most people sell near the low and buy back higher because emotions reverse at exactly the wrong time. The antidote is structure, not confidence. The 2-market model. What you see versus what you own. If you own physical silver, you own an object with properties, conductivity, scarcity, industrial utility, monetary history. If you trade paper silver, you trade a contract inside a system. Margin, settlement, liquidity, leverage. They are related. They are not identical. Today was a reminder. Paper can move like a guillotine. Physical moves like a ship. Slow, heavy, real. So don't judge a ship by a guillotine's speed. What I'd tell 3 different people right now. Person A, the day trader. You're not trading silver, you're trading volatility. If you can't define your risk per trade and survive whipsaws, you don't have an edge. Only adrenaline. Reduce size, trade levels, respect the tape. Person B, the long-term investor. Your job is not to predict the next 3 hours. Your job is to avoid getting emotionally kidnapped. If your thesis is long-term, you scale, you don't lunge. Person C, the physical stacker. Your focus is availability and premium behavior, not intraday chart drama. Use volatility as a shopping environment, not a panic environment. Stay liquid enough to take advantage when screens get stupid. A simple risk math check. Do this before your next trade. Write this down. If silver can drop 8% in 3 hours, then a 12% day is not fantasy, a 15% week is not impossible, and a 20% shakeout is not a conspiracy. So ask, if my position moved against me 12% tomorrow, would I A, be annoyed but fine, or B, be forced out? If your answer is B, your size is wrong. It's not about bravery, it's about survivability. Okay, but does this change the big picture? One flash crash does not rewrite the long-term story. What it does is remind you that the road is not straight. Big trends still have pullbacks, breakouts still get tested, crowded trades still get shaken. The market's job is to transfer metal exposure from emotional hands to disciplined hands, and it uses volatility as the transfer mechanism. So the big picture question becomes, did this flush remove leverage without breaking the underlying uptrend structure? That's the real analysis, not the headline. The next move, 2 scenarios. Scenario 1, base and relaunch. Price stabilizes above the panic zone, builds a shelf, and then grinds back upward. That would suggest today was a leverage purge, not a trend reversal. Scenario 2, aftershock, unwind. Price can't hold the base, and the market continues to unwind positions. That would suggest today was the first crack in a larger deleveraging phase. And here's the truth. You don't need to guess. You can wait for confirmation. Patience is a position. What to do tonight? Yes, tonight. Here's your practical end-of-day routine after a move like this. Review your exposure. Know the number. If you can't say your risk in one sentence, you don't know it. Cancel revenge trades. The market is not your enemy. Your impulsive brain is. Write your plan for both scenarios. If price holds, what do you do? If price breaks, what do you do? Sleep. Seriously. Fatigue is a financial liability. The moment the market separates amateurs from pros, a flash crash is a mirror. It shows you what you really own. It shows you what you really believe. It shows you whether your plan is real or just vibes? Today, silver went from $93.61 to about $86.24 in 3 hours. That's the headline. But the deeper story is this. Volatility is the toll for being early to a trade the world is waking up to. Pay the toll with discipline, and you survive. Pay the toll with leverage and ego, and the market collects you. If you want me to keep doing these breakdowns, fast, mechanical, and actionable, drop FLASH in the comments. And remember, the next big move won't announce itself politely. It will arrive like a door kicked open. Be ready. Rapid fire. No, this doesn't kill silver. Yes, it warns you about leverage. If you panicked, size down. If you stayed calm, keep your process. We'll watch the base, the rebound quality, and the next liquidity window. See you at the next update. Stay sharp, stay liquid.